Hi everybody, this is Ellman, the blue-collar investor, with today's covered call writing question of the day. And today's question comes from Chuck of Glencoe, Illinois. I'm trying to understand how the option buyer makes a decision to act, purchase the stock, or sell his option once his call purchase has been shown to be a good move. I assume, but I'm not positive, that the option can be exercised or sold by its buyer any time after it's purchased until expiration. Does this happen often? Why wouldn't the call purchaser sell back his option or buy the stock once the goals for the trade are met? Isn't there also a risk that the option price or stock price will go lower as time goes on? Well, Chuck, yes, this is a common question that we get from our members looking at the other perspective from the side of the option buyer. Why isn't that option sold or exercised prior to expiration? So let's break down your question into two parts. But first, let's take a look at a typical options chain that we'll use as an example to respond to your question. In this case, I've selected Protolabs, which is one of the stocks currently on our premium watch list, ticker symbol PRLB. You can see on the screenshot that the stock is currently trading at $64.97. See that in the upper left-hand corner. And if we take a look at the options chain and we scroll down to the $60 strike price, we could see that in the bid column, that option is currently worth $6.10. Of that $6.10, $4.97 is intrinsic value, the amount that the $60 strike price is in the money. So $64.97 minus 60 gives us an intrinsic value of $4.97. So let's keep those stats in mind for when we discuss whether there's going to be early exercise. Now, let's break down your question into two parts. Is it possible that there is going to be an early sale of that option prior to expiration? Well, there's definitely that possibility because the option buyer will sell that option if his goal is reached. He also may sell that option if the trade turns against him. The price of the stock starts declining, the price of the corresponding option starts declining, and he may want to sell that option to mitigate losses. You know, it's very similar to when you buy a stock. You buy a stock, the price goes up. If your goal is met, you sell the stock, thereby generating a profit. If the price of that stock starts to go down, you may want to sell that stock before you continue your losses to even greater levels. So it's very similar to that. However, bear in mind that if the option buyer does sell that option, it does not impact us, the covered call writers, in any way whatsoever. We've generated our initial premium from the sale of the option. That's ours to keep no matter what. We still own the shares, and so there's no effect whatsoever if an option buyer sells that option. Now keep in mind that our shares can be exercised early at any time because we don't sell the option to any specific person. It goes into a pool. So at any time up to 4 p.m. expiration Friday, early exercise is possible, but highly unlikely and very, very rare. Okay, so that takes care of one aspect, selling the option prior to expiration. Let's take a look at the other one in your question, early exercise prior to expiration. Now here, the chances of early exercise is extremely, extremely rare because it simply does not make any financial sense. Let's go back to our example of PRLB, where the $60 call, if it were exercised, the option buyer would then buy the shares from us at $60 and can turn around and sell them at market at $64.97, thereby generating a profit of $4.97. However, if the option buyer just simply sells the option, he will generate $6.10. In the first instance, he's getting intrinsic value. In the second instance, he's getting both intrinsic value and time value. And that's why it rarely makes sense for early exercise because the option buyer is losing out on any time value that's remaining in that option premium. The exception to that is if there's a dividend distribution where that dividend is greater than the time value remaining on the option premium. So in this case, the dividend would have to be greater than $1.13. So selling the option generates both intrinsic value and time value, whereas exercising will generate only intrinsic value. Chuck, thanks so much for that question. I know many members were probably thinking to ask that very same question. It comes up frequently, so I appreciate it very much. And thanks to all of you out there for viewing this video. I hope you found it useful. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.